I've seen it play out 100 times. You and a friend get together and decide to start a business. You have a great idea and you both bring different skills to the table. And you think, this is gonna be so great. You decide to split everything 50-50 to make it easy and clean and start a business together. But flash forward a year and the initial excitement is worn off, and now you're dealing with taxes for a partnership, and maybe even one of the partners is feeling like they're being taken advantage of. Maybe they feel like they've done a little more than their share of the work, or maybe one of the partners wants out. And now all of a sudden, things get messy, really messy. Because you started as friends, you might not have a contract or legal boundaries or really a sense of knowing what to do in this situation. And that is exactly why I don't recommend structuring your business as a general partnership. I'm Jamie Trull, CPA and financial educator, and here on this channel, I love to bring you all the information you need to stay informed, organized, and profitable in your business finances, so please make sure to hit that subscribe button. And here in this video today, I'm going to tell you about what most business owners get wrong when it comes to partnerships, the hidden costs that you might not be aware of, and how I recommend structuring instead. Because you want to make sure that you're protecting your business, your financial future, and your relationships. Now, here's the thing. Partnerships sound like the easiest way to get started. You and someone else have an idea, you decide to get together and split everything 50-50 right down the middle. And what most people don't even realize is that you don't have to file paperwork to become a general partnership. You are automatically a partnership the moment that you start a business where more than one person has a share of the profits. And that means that all of a sudden you have all the tax requirements of a general partnership. So not only do you now have another tax filing you have to do for this entity every single March, which is a 1065 partnership return, but now you're also on the hook for all of your partner's decisions, even if you didn't agree. Not only that, you're personally liable for any kind of debt or legal obligations. And if there's a conflict and you don't have an operating agreement to figure out how you're going to sort things out, well, that can lead to some legal battles. Now, first and foremost, let's dive into those tax consequences, because this is something most partnerships don't realize until they go to file that first tax return. Now, unlike a sole proprietorship where you can just file with your regular individual tax return each year, when you have a partnership where more than one person owns a share of the company, that means you have a different filing requirement. Your partnership 1065 is going to be the tax return that you file for your business. However, because a partnership is still a pass-through entity, that 1065 just serves to be able to tell the government and tell you what your share of the profit is that you need to claim on your tax return. So once you do the 1065, then you can generate K1s, which essentially are kind of like W2s. They will tell each business owner their share of the profit that needs to be claimed on their individual tax return. And here's the thing, regardless of whether you actually took money out of the business or not, you have to pay taxes on your share of the profit. So even if your partner pulled a bunch of cash out of the business to pay themselves, or they had a whole bunch of expenses that they racked up that you didn't agree to, you're still having to pay taxes on half the profit that your business paid. And unless you go the extra step to create a multi-member LLC, you also have no legal protection. There's no firewall between your business and your personal life to protect you in case there are legal issues that come up. That means that if your business gets sued for any reason, it could be your home or your car that are actually up for grabs. So if you are set on having a business that has multiple owners, I always recommend going the step to actually create a multi-member LLC. That means creating an actual business entity with your state's Secretary of State, and also ensuring that you have a real documented operating agreement that you've preferably worked with a lawyer to create. If you go down this road, here are some things you want to make sure that your operating agreement covers. First, ownership and capital contributions. Is anyone required to put money into the business? And what is the general ownership split? If additional contributions are required later in time, how is that going to work? The key is to make sure that how this company is financed is thought about ahead of time. And that'll hopefully prevent the discussion around who put more money in. The second thing you need to make sure you include in your operating agreement is roles and responsibilities. This is where I see things go sideways all the time. A lot of people assume that because they're friends or they've known each other for a long time, that they're going to put in equal work and that they're always going to be able to agree on a decision. But what happens if you don't agree? Or if one person feels like they're pulling more weight than the other person? And how do they make decisions on how to spend money? Is there a threshold over which they need to get both partners' approvals before they spend? And what is each person responsible for at the end of the day? You need to be able to have something concrete to point to in order to determine if both partners are living up to their end of the bargain. The hope is that this helps you get in front of any disagreements over control, which you might not think you're going to run into, but let me tell you is more common than you think. Third, you're going to want to talk about compensation structures. How will each partner be compensated? Are they just taking out a share of the profit? And how often can they take that share? Are they also going to get guaranteed payments? And how are those distributions going to be tracked from a tax perspective? Remember, you're probably starting this business to actually make money, not just for the fun of it. So you have to think about how you're actually going to be able to take money out of this business in a way that feels fair. What happens if someone wants out? How exactly would that happen? Would there be a buyout? How would you determine the value of the business? Could they sell their interest to someone else? And who owns the intellectual property? All of that is really important, and it's one of the reasons that it can be hard to really tie yourself in with someone else because you're building something together. And if someone wants or needs to leave at some point during the future, it can be really hard to pull that apart in a way that makes sense for both parties. And last, you want to be talking about dispute resolution. If there is a dispute, how will it be handled? And in this one, I'm not talking about your everyday disputes. I'm talking about the bigger ones, the ones that need legal. You'll want to be able to determine which state laws are going to govern the agreement and whether you'll go to mediation before you go to litigation. Again, I know this feels extreme, especially when you're in that excited beginning of a partnership. But remember that over time, things can and do change, and it's important to really think about this ahead of time. Overall, an operating agreement is set to do multiple things. It's going to help you clarify expectations, align tax and legal structure, and reduce emotional interpretation when things go sideways. And of course, your operating agreement is a living document, which means if roles and responsibilities or your business changes, you should be updating it regularly. All that said, partnerships are more complicated than they might seem initially. And that's why even if you decide to go the route of a multi-member LLC, it's still not my favorite business structure. Even if you have an ironclad operating agreement, it still doesn't guarantee that things aren't going to get a little messy. And that's just the nature of human relationships. Now, in order to avoid the headaches of dealing with a partnership, there are a few other options that are much simpler when it comes to tax and legal. The first option that I often recommend is for one person to be the owner of the business, the 100% sole owner, probably of an LLC, and the other person to be a paid contractor for that LLC. Now, you can structure how that contractor is paid however it makes sense. It may even be, let's say, half the profits from the business entity go to the contractor. Now, of course, you're going to want to document how that compensation is determined for that contractor, but ultimately, at the end of the day, you end up with a very similar money split that you would if you had a partnership. However, the person who owns the LLC will likely have the last right of decision-making for the business. Ultimately, what's happening is a revenue share agreement instead of an ownership agreement. And that means no partnership tax return to be done, and it's also significantly simpler to dissolve. Now, to me, that is the simplest structure option. But I also recognize that some people feel like there might be a little bit of an imbalance in those situations. So there is a second option, and that is for both people to start their own business entities. Now, these would both be separate entities, probably separate LLCs that each one of them controls 100%. And then when they do business together, they actually form a joint venture. This is often a really specific written agreement where you're writing out exactly how you are going to partner. Now, if you do it this way, I recommend to keep things fully separated. That means each business has its own business bank account, and either each business does the invoicing, let's say to collect payment. So maybe one entity invoices half and the other entity invoices the other half, or you have one entity that is in charge of collections, and then they remit the portion that belongs to the other company directly to them. So an example of this is, let's say you started a home design company with a friend of yours, and you're really good at the sales and marketing side, and your friend is really good at the actual design side. Well, in that case, each of you would have your own business. Yours would be a sales and marketing business. Hers would be a design business. She could go out and get the clients and potentially even take payment and remit you part of the payment for the work that you're doing. Or she could bring the clients in and hand them over to you, and then you do the administrative work and pay her out a commission. Ultimately, the end result is the exact same as a partnership. However, it's significantly simpler and less risky. And not only is it simpler, but it also can be better for relationships. I've found in the real world that people who structure things like this end up with less resentment and less issues than people who actually form a long-term partnership. And while structuring something in this way might feel more complicated at the beginning, it actually is significantly simpler as you move forward. If you're interested in learning more, maybe about the difference between an LLC and an S corporation, definitely check out this video next. And if you found this helpful, I talk about this plus so many other important things that business owners should know in my new book, Hidden Profit. You can grab it pretty much anywhere books are sold, and if you go to jamietrull.com/book, you can grab some bonuses just for ordering it. Thanks for joining me, and I'll see you next time.